Alright, Freedom Builders, welcome back to the channel. And my apologies if you are getting the feeling that I'm spamming you a bit with videos about the markets. But the reason is that I am getting a ton of questions on my Facebook sites and via email and so on. And they are pretty much the same, or at least variations of the same questions. So I thought I would make a video here to describe what I think of the next week or so, at least a bit into the future here. It is very hard to predict, and some of the questions I'm getting is, what do you have a technical analysis look at the market right now? And no, I don't. And the reason is that technical analysis is what you call the study of repeatable patterns, meaning that when the market is calm and soft and easy to look at, then there are actually patterns that repeat themselves over and over again, and you can make money on them. I've done that for many years now. However, you should also know the backside or the weak side of technical analysis, and that is that in extremes like right now, it is hard really to do any analysis of that. So I'll not really comment on anything about the market itself, but I do have a couple of outlooks as to what I expect. Because one of the things that really drives the market, or at least that has been driving the market for some years now, is interest rates. And when Fed, that's primarily Fed, but also the European Central Bank, ECB, and the British and the Chinese Central Bank, when they are, for instance, lowering the interest rates, then usually we see a spike in stock prices. There are a number of reasons for that, but when interest rates are lower, you could see that companies are investing more, they are borrowing money to invest in their company, and the entire economy is growing. That is normally something you do when the economy is slow and bad. And it is a bit extraordinary to see that Trump last year kind of bullied or pushed the Fed into lowering the interest rates, and at the same time saying that the economy was absolutely fine. But that's another story, and there can be different aspects to that. So it's not to start a political story, but just to say that there has been a pressure to lower interest rates. And right now, I just made a little PowerPoint slideshow here saying Fed to the rescue. Right now we are seeing a push to from the political side, from Donald Trump, to have the Fed to lower the interest rates now in the corona situation. This today there was this, I think it's a tweet or something, that our Fed should start being a leader, we should have the lowest interest rates, blah blah blah, look at Germany, look at Japan and so on. So what he's actually doing is using some open official platform to try and put some pressure on Fed. Now, Fed has done this several times before. During the 2008 crisis, they had what was called QEs, quantitative easings, where they were buying up massive amounts of bonds, which when the bond prices get higher, that lowers the actual interest on the bonds. So they have been buying up bonds for several times now, and you can see here the red line here is the S&P 500 index, and in these QE packages, and that was many billion of dollars that we're spending there. You can see this is where we started to see the end of the downturn in the markets in 2009, and they had a long QE package there. They took a break, and the market went down. Then they started another QE, and the market went down and a bit sideways, and that was here. And then they started yet another QE. And of course, they're not starting QEs just by looking at the market, because the Fed, they are pretty much, they don't care what happens to the market as a stock market from day to day. What they do have a look at is the overall economy, and when the economic numbers are getting really bad, or at least indicating that it is going in the wrong direction, then this is one of the tools they have. The problem is that the interest is already low by now. And the question is if they really want to lower it anymore, because every time they lower it, they are getting closer and closer to the point where they don't really have any tools when a true recession hits. So it is a question if you believe this corona situation could actually trigger a worldwide recession. And if you believe that, then of course it could make sense to make some financial stimulus here. You can see that the power of the Fed, the power when they are increasing their balance sheet, when they're buying up bonds, you can see here that from 2008, you can see they did this different QE packages. Then they went sideways for a long while. And if we're taking a look at the market in 2015, just having a look at the market here, you could see the effect of the Fed not buying any bonds in this period. It actually stayed sideways and also had some huge drops. We had one of our larger drops here from a bottom to or top to bottom of around 15%. So they do have quite a lot to say here. Let's just go back here. Then they started to sell bonds, and you saw the results in the fourth quarter of 2018. We can just jump back here and have a look at the fourth quarter of 2018, where the market really tanked. And then here at the just around New Year, I think it was the 26th of December 2018, Fed announced that they, when looking into 2019, they saw absolutely the possibilities for starting to decrease the interest again. And that was enough. From there on, the market just went straight up in a straight line here. So that's what happened here. They didn't do it until somewhere into 2019, but just mentioning it here at New Year was actually enough. And then they have been increasing the balance sheet. And that is a lot to do with the pressure from Trump. He was actually directly or indirectly threatening to fire Jerome Powell, the head of Fed, at some point. And there have been a lot of fightings there. The funny thing, or the paradox here, is that I actually completely agree with Donald Trump when he in 2015 said that a country in a great financial shape should never have such a low interest because it was making a false bubble, a false economy. And he said that the only reason Obama and Fed was actually keeping the interest low was to give some mirage, some fake picture of the economy as being great. So then, of course, he became president, and then one's perspective changes, I guess. So now he would very much like the interest to be lower, even though, as he keeps telling us, that the US economy is in the greatest shape ever and ever. So that is kind of the picture right now. Now, what is something that that makes me think that Fed will actually start lowering the interest rate? Well, there are several different things, and that is not only pressure from Donald Trump, because I think they actually considered it before. But if you are looking at, let's just go back here, just for a start, just looking at the coronavirus here. I got some questions as to why the real drop in stock prices just came a few weeks ago. Why not in the beginning when the coronavirus was growing in China? And well, I have the sad truth for you that in the Western world, China is mentally very, very far away. So when people are dying in China, it has nothing really to do with us. I know it sounds cynical, but that is kind of how a human brain works. I'm pretty sure that if something hit Europe but hadn't hit China yet, they would have a bit of the same, where when the distance is very far in geographical terms, then it is hard really to get emotional about it. But then, all of a sudden, just a few weeks ago, this distance between these two lines, the yellow and the purple here, the purple is totally confirmed in the world, and this is just mainland China. And the difference between these two, as I mentioned in the video the other day, is the purple line here. And you can see that on a logarithmic scale, this is just going up, 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 and growing with something like 30% per day. And right now we are at around 6,500 or so. If that were to grow with 30% per day for the next month, we would have something like 16, 17 million cases outside China. I'm not certain that it will, because a lot of measures have been taken to keep it down. But then again, the virus is in more than 50 countries, I think, right now. So right now, total confirmed 6,762 doesn't sound like too much, but adding 30% every single day is kind of the power of compound interest, and that is pretty much. So this is why I think that the central banks, and we are not just talking about Fed here, I think we're talking, I could imagine, and maybe that is wrong, but I could imagine that Fed and the ECB, the European Central Bank, maybe also the central bank in China, actually went in to do some sort of joint intervention, where they're actually lowering the interest rates in several different markets to really give a kick to the economy. Of course, the problem is that kick to the economy, if people are staying home and not buying stuff, that is pretty much the worst thing that can happen to our evolved economy. That is consumers not consuming. So imagine that all Disney worlds all over the globe has to close down, or nobody is visiting the hotels or the Starbucks or the whatever where people are gathering, and the mall, they are not going shopping and so on. That is pretty much something that I don't think can be solved by just lowering the interest rate by 1/4 or 0.5%. If we're looking at the probabilities of the interest being lowered, then there is this website, and I will link to it below. It's called the FOMC countdown, and the FOMC meetings is where the Fed is announcing what they will do with interest for the next month and a half. And you can see right now there's a countdown to it. This is not just because of coronavirus. This is just a website that is going that is always running and counting down to the next meeting. If you are a serious investor, I think this is something you should have a look at, maybe once or twice per month, to see what where the interest might go. And if we're looking at the current situation, then we can see right now the interest rate is what is called 150 to 175 basis point. That means 1.5 to 1.75%. So there should actually be some sort of box here. If someone thought that there was a probability of the interest being held the same at the next meeting. But right now, and this is something that is derived from futures prices and so on, but right now it is, they can calculate that there is about a 5% expectancy of an interest decline of 1/4%. And there is a 95% chance or probability of 0.5% rate decline. And that is, could I say, crazy. Well, not crazy, but it is something that is rarely seen. Because just a month ago, we can see down here, a month ago, no one thought that 0.5% was a probability. 26.6% thought that 1/4%, but nearly 3/4 of the market thought that it would just stay at the current rate. And are we going back maybe 2 or 3 weeks more back in time? I don't have the stats here. It was actually around 80% that thought it would stay at the current, and there was almost 20% thinking that the interest rate would be hiked, would be increased. So that is how quickly things can shift. And this is just in 17 days. Here we can see the probabilities out in time. We can see here that this is the next FOMC meeting at the 18th of March, where we have the 95 and 5%. But take a look 5 weeks later. We can see from the Fed Fund futures and so on that there is an implied probability here of 73% that it would be lowered 1/4% more. And if we're going out 1.5 months more, we have almost 40% thinking that the interest rate will be down between 0.5% and 0.75%. That really shows us that there is a huge speculation right now into Fed lowering the rates. And to be honest, I can understand that they think it, and I can really understand that Trump wants it, because he has really tied a lot of his leadership measuring how good of a leader he is. He has kept saying that we could just look at the stock market. The stock market was great, which somehow equals that he was a great president. I kept saying, and that's not just Trump, that is under Obama, it has been under Bush, when people have tried to say that a president is great and clever and have a high IQ, and use the stock market as an indicator of that. You should be very careful doing that, because then you should also be ready to admit when the stock market is going down that the president is an idiot. So honestly, you cannot measure a president's qualities from the stock market, in my opinion. But of course, I could be wrong, and you are very welcome to disagree, but that's just my opinion. That is simply insane. But that makes it a logical conclusion that Trump would want Fed to lower the interest rates as much as possible, because he wants the stock market to stay on a high level up until November, where he hopes to be re-elected. If he will be, pretty much, I think, could come up to how he handled this crisis. Because if he flukes here, if this is not handled correctly, that could come back and haunt him in the re-election campaign. But let's see. He has survived the craziest things, so maybe he'll also survive this. Nobody knows. But that is just to say that there is a large probability, or that is how it's seen in the market, as to that over the 2020 here, there's actually, or let's see, just here in December 2020, that's 10 months from now, there's actually seen a 10% probability of the interest being zero. And that is something rarely seen. And it is rarely seen that the shift has been made so quickly. So really, really crazy. Something else that also tells me, or tells me that there is a probability that the Chinese central bank will follow or will join in some sort of rate decline is, if we're looking at my FX book, that is one of the places I am looking for these financial numbers. There are a large number of these sites showing the different economical numbers. This is the website I am looking at when I'm trading currencies as well. And we can see that here on February 29th, just the other day, we had the Chinese PMI numbers coming out. And a PMI number is, it says here, the official non-manufacturing PMI releases blah, blah, blah here. And the survey is based on 1,200 companies covering a lot of different industries. And that is their expectations, the purchasing manager's expectations to the future. And when that dips below 50, it indicates some sort of contraction in the economy, at least some sort of recession, maybe not an official recession, but some sort of contraction. And you saw that last time it had a 54, which was great. It was expected to be a bit lower at 53.8, but the actual number was 29.6. That, I must admit, I don't think I have ever seen that before, such a huge drop. And that is, of course, due to the close down, the shutdown of the coronavirus. You saw the same, this was the non-manufacturing, this is the manufacturing PMI. And here we saw 50 last time, expected 46, but down to 35.7. So there's no doubt that the Chinese government is desperate to put some sort of stimulation package into the market. And if they do that, if they lower the interest, if they do something like that, put some sort of QE package into the market, then I will almost guarantee that the Fed will follow, or at least that Trump will make a huge pressure for Fed to follow, because as he states in this message here, he is comparing the United States with other countries, and of course you could say, but he wants the interest rate in the United States to follow the other countries down. So of course, when your interest rate is low, your currency is also, everything equals, but is also dropping. So if if you are into currency trading and you can see there is a risk for the interest rate in United States to drop, then that would also make the currency, the US dollar, fall in value. But that is a subject for a complete other video. But that is just to tell you, this is the scenario I think we are entering into in the coming week. Maybe today, actually, maybe when I upload this video, it will already have happened. We can see Trump will hold another press conference today on the latest coronavirus developments at 1:30, so well, that's some hours from now. And maybe Fed will also go in already or today to put some something about the interest into work in the market. So I think we are in for an extremely volatile week, and if this comes out, just to talk about how that will affect the market, I am pretty sure that that will make the market somehow bounce. But you should be aware of that. I'm not sure how the big funds are positioned right now, but some of them might be very, very anxious that this could go into a real recession and really could hurt the stock market. Remember that a recession is not on the stock market. A recession is 2 quarters in a row with falling GDP, with shrinking GDP. So that has actually nothing to do with the stock market, but of course they're tied together. So that could be a number of large players in the market waiting for a bounce this week just to unload a lot more stocks and sending the market further down. It could also be, and that's the other side of the coin here, it could also be that these large players are saying, well, now the market is actually down to a reasonable valuation, so we'll just start buying from here. And that is what is sometimes seen. And of course, that could be the argument for buying on the dip, so that people are saying now things have gotten too low, the market has panicked too much, so now is the time to buy. I will personally not be buying this week. I am a trend follower, so I'm not buying into a falling trend. It is called to try and catch a falling knife, and I am not convinced that the market will go up from here. And the reason I'm not convinced, to get back, is the purple line here. As long as that is rising with 25, 30, 35% every single day, you will see more and more businesses being hit, countries shutting parts down. You will see some financial reports in the Q1, Q2 here that will be severely hit. And since nobody is really knowing who will be hit the most, I think that the large funds will go for the better safe than sorry approach and simply maybe not selling so much anymore, but not buying. And when the big funds are kind of withdrawing their liquidity from the market, that could really make it sink easily 10-15% more. But no one knows, and this is not a prediction, this is just me trying to explain the different scenarios that I'm assessing right now. I will not be buying stocks in the next week. I will be watching and seeing how the big players are faring in the market. All right. Sorry that the explanation was a bit long and a bit theoretical, but there are a lot of moving parts in this jigsaw puzzle here, so I thought I would just try and give you a picture of how I see it. If you haven't done already, remember to hit that subscribe button and like button and all of that down there. And I will talk to you soon, and hopefully we'll have some more positive news when the week moves on here. All right, talk to you soon. Have a nice Sunday. Bye for now.